When prices are going up, there's only two questions people can ask. A stupid question or a smart question. The stupid question is, now that prices are going up, should I buy? This is usually what happens when people that have nothing to do with Bitcoin or crypto as a whole, when they suddenly see it being covered in the media, they see it's going up, they are wondering, should I buy as well? But then there's also the smarter question, and that's a question probably the majority of the people that watch this channel pose. And that is, at what point in time should we potentially sell? When should we take profit? Because probably you have bought when we were below the realized price, right? When Bitcoin was at 20K. You probably also held Bitcoin while it was still above the 120-day simple moving average. All the indicators that we look at this channel still work very well in this cycle. But still, the question is, at what point in time does it make sense to take profit? Now, there are plenty of approaches, plenty of models, and some models work better than others. And I want to discuss in this video what potentially makes a good versus a bad model and where Bitcoin might potentially peak. So here's an example of a bad model. This is the Bitcoin rainbow chart. It's very entertaining, it's colorful, it's very popular as well, but it's not particularly useful. And here is why. We want that the approach that we use worked well in the past. And we can't necessarily say this for the Bitcoin rainbow chart. In the early days, we had a sell signal when Bitcoin was at $5, but then it ran up all the way to $25, even $30. We had another 6x from here. Then in 2013, the model expected us to peak at $460, but we went all the way to $1,000, etc. So we tended to get selling signals that happened too soon in the early history of Bitcoin. And then now recently, right, say in 2021, we didn't even get a selling signal. So really, this trend seems to be starting too low and it seems to be closing too high, as in the slope of this trend channel is too steep. We should probably start somewhere around here and we should probably have much less slope and thus imply less growth. In other words, I think it's very unreasonable to expect Bitcoin to have any chance at all to hit $1 million in just 1 or 2 years. I think that's way too optimistic. Now, this approach can be applied for pretty much any model. We can have a look at how well did it work in the past, what kind of biases might be implied in the model, and then potentially adjust the predictions based on those biases. So instead of looking at the rainbow chart, there's a slightly modified version. This is the Bitcoin power law chart. Here, at least, we've got 3 cycle tops that align pretty well. But again, unfortunately, in 2021, the power law expected us to hit more than 100K, which we did not at the time. So really, this is another indication that probably the higher level that's shown over here, 500,000 and potentially more in the next 12 months, is probably an overestimation. Now we could simply just connect those different cycle tops, right, with a curved line. If we do that, we tend to see an underestimation of the growth rate. So have a look at this. It's again Bitcoin's long-term chart. This time we've got a curved line. There's nothing mathematical about it. But what's interesting is that historically that line connected the cycle tops extremely well. And when we look at the recent price action, again, we got a nice hit. But now with the rally in the last few days, we broke that resistance. So the Bitcoin growth rate is not slowing down as quickly as this curved line would imply. Now, all of those approaches just looked at price data, but here's the big advantage of crypto. In crypto, we can have a look at the individual transactions as well. We can have a look at how actively is Bitcoin traded, how long is it held by the long-term holders, when are the long-term holders starting to sell, etc. That's data that we don't have for traditional finance, for the stock market, for example. And that additional data does help us. Now, there are different on-chain metrics, and I'm not going to explain all of them in detail, but there is an explanation how they're calculated here at the bottom of the page. This all comes from Bitcoin Magazine Pro. And in this particular example, we are looking at the average cumulative market cap and we multiply this by a number that historically aligned the tops very well. Again, we got 3 cycle tops that got connected, but unfortunately we did not hit that top cap in 2021. Quite a bit of a delta, right? 110, 120K was the prediction. Now, why am I so particular about that particular top? And why do I dismiss a model, or why do I say it's not working that well when the recent top wasn't reached? It's because we use those indicators in order to potentially rebalance our portfolio, right? If we buy Bitcoin very low, let's say we've got 10% of our net worth in Bitcoin, and then Bitcoin does it 2, 3, 4, 5x. Now we've got, say, 30, 40% of our net worth in Bitcoin. We are looking for exit opportunities, right? We don't want to have half of our net worth in Bitcoin if it can drop by 60, 70, 80%, right? We need to reduce volatility, especially if our net worth is relatively large. And because of that, if an indicator did not flash a potential selling signal when afterwards we went down from above 60K all the way to 16K, right? The 70% drop. If we can't get spared from a drop like this because we didn't sell on time, then the indicator isn't as useful as it initially seems. And the larger the gap is to that recent top, the more problematic the indicator becomes. So the top cap isn't necessarily great, but it again tells us that 545K in Bitcoin anytime soon is not that likely. So this is, if history is any indication, a not very realistic price target. Here's a delta top, which is slightly better if you look at this. Again, we did get hit in those cycle tops, and the delta in 2021 wasn't too massive. We had a delta top of 56K and the price was at 40K. When Bitcoin actually topped out, the delta top gave us a 103K prediction. So yes, there is still a gap. It's not perfect, but at least it's slightly better than the top cap. The best of those kind of indicators is probably the terminal price. Now, the terminal price did hit in 2021, but there is still a potential caveat to this, because when we look at the cycle tops in the past, we actually overshot in the past. So there is still a bias here. We just barely reached it in 2021, but in 2017, we did overshoot by roughly 50%. So we don't necessarily have to hit the terminal price again. We overshot more and more in the past. The adjustment isn't happening as quickly as it should. And so I think we can be lucky if we hit the terminal price again. I think it's better to sell before reaching that line. Because again, if we overshot more in the past, now we're overshooting less, we might not reach it at all in this cycle. And currently the terminal price is at 240K. So selling at 180, 190K might not be that bad of an idea. Again, depending on, of course, how much you already are in Bitcoin, how large your net worth is, and how much you want to diversify into non-correlated assets like property or precious metals, etc. Because here's a topic not many people talk about because it's not very sexy, but the marginal utility of money tends to decrease over time, right? The first $10,000 that we have are super valuable to us. But if you go from 100,000 to 110,000, we add the additional 10,000. It doesn't really make that much of a difference anymore. So over time, the additional dollar makes less and less value to us. Thus, it's just rational that over time we become more and more risk averse. And if we have, with a rising Bitcoin price, more and more allocation towards crypto, it's just rational when our net worth is many, many years of our income to diversify to a degree and to hedge ourselves against a potential 50, 60, 70% drop. Yes, I know some Bitcoin maximalists say that the best time to sell Bitcoin is never, and the best time to buy Bitcoin is now. But still, right, it's all about how much is the capital worth to us personally. And if you're going from, say, 10 years of our income in net worth, right? Let's say we've got an annual income of 100K, our net worth is 1 million. If we then drop from 1 million down to just 300K, because we all have it in crypto, that's very, very painful because we cannot really save ourselves out of that hole, right? We can't just save our income and then get those 700K back. That's a problem, right? So once our net worth relative to our income is comparatively high, we have to become more and more risk averse. We can afford less volatility. Yes, we might reduce our expected future return, but again, that's okay because an additional dollar is not worth to us as much as a lost dollar because of the declining marginal utility of money. Now here's another interesting on-chain chart. This is actually a combined chart out of several models. We've got the Pi cycle top indicator, we've got the realized and unrealized profit and loss. We've got the realized hodl ratio, how much active speculation is there. We've got some momentum indicators, etc. With all of that combined. And then we get something interesting. We get a chart that peaked out pretty perfectly at the top of the different cycles. And recently it's comparatively high at around 80%, but it hasn't yet hit above 90. And every time when we had a 60-70% correction, we previously hit the 90. And yes, there's maybe some slight marginal reduction in those peaks here as well, because we didn't hit 100, we only hit 97 over here. But still, right, if we now go to 90 or 95, then is really a good time to potentially sell. It does not look like we have hit the cycle peak yet, but it does make sense when we are over allocated to sometimes rebalance the portfolio, especially once we hit 90 and above on the CBBI. There's of course an argument to be made here that maybe we don't see those accelerating bull markets anymore, those blow off tops anymore, because now it's not retail that's driving the Bitcoin price. It's traditional Wall Street, right? It's the ETFs, it's the treasury companies, so the Michael Saylors of this world, right? They are now accumulating Bitcoin and pushing the price up while the retail interest is relatively low. So maybe when the kind of investor is now different, maybe we do not see an acceleration in the Bitcoin price anymore as we did in the past. And maybe those indicators that worked so well in the past won't work that much anymore in the future. This is a potential argument, but I tend to disagree with it, and here's why. To me, it looks like the accumulation by traditional finance is actually accelerating as well. What we've got over here is the combined balance of the ETFs, so that's in purple, and some Bitcoin treasury companies. And this starts in January of 2020, goes all the way to today, and initially the accumulation was rather slow. In the last 1.5 years, this tended to accelerate. But what I find so interesting about this is that even though this looks like a linear accumulation, right? This is almost increasing without a single dip, maybe a little one over here. But what's really fascinating is that this is measured in BTC, right? How many Bitcoin are held. But during the time, in those 1.5 years, the Bitcoin price did roughly a 3x. So the number of Bitcoin, the rate at which Bitcoin gets acquired, is unchanged, but the price 3x'd. So in order for this line to stay at the current slope, the US dollar inflows must have also 3x'd the rate of the inflows. So we're seeing faster and faster inflows over the last 5 to 6 years, right? This line, the number of Bitcoin that's held, is potentially even accelerating over all of those years. But the Bitcoin price itself went from 7,000 all the way to 120K roughly. In other words, the inflows into Bitcoin or into crypto as a whole are growing faster than the Bitcoin price is. So there is an acceleration of purchases. I believe there is a good chance that we will see a blow off top. Even with the institutions, they seem to be buying at faster and faster rates measured in US dollars. Now, I do have an announcement to make. I always talk about how to bet on relative valuations, right? How some altcoins might outperform or underperform Bitcoin and Ethereum, and how those relative valuations aren't that volatile, right? We tend to see relatively clear trends, and how there's quite a bit of alpha to be made with this, right? We can outperform using those clear trends. The only issue is that for most people, this is a bit too complicated, right? You have to learn the platform, you have to learn risk management, how to adjust stop losses, etc. And so here's now the big announcement. I have launched for a small number of people to just deposit capital into a capital pool and then automatically copy trade whatever I do. The launch happened 24 hours ago for the annual subscribers of premium of this channel. And it's already going well. Of course, there might be some volatility to the downside, but currently we are 1.7% already in profit. Before that launch, I tried this out myself on a personal account. So I started with 40K, moved this to 60K within 2.5 months. And while I don't expect to get the same kinds of returns when moving more capital and when maybe luck isn't that much on our side, I still believe that the strategies we are using will yield long-term risk-adjusted positive returns. So in the early days, I did this all with borrowing and lending platforms with DeFi. Now I moved to perpetual futures, right? Bets on the price. But this relative valuation bet approach, I already do this for almost 4 years. So that's what this chart is showing, right? If I just dollar cost averaged into Bitcoin, I would have gotten this light gray line as return. But instead, I got the black line in return. And here's how I do this. I check for altcoins that have a quickly rising supply, while the demand doesn't grow at the same rate. So this is the example of Balancer. I show this very often here publicly on this channel as well. Of course, there are way more examples that I share in the closed community. But because of that token inflation, relative valuations tend to go up very, very steeply. So this is now Ethereum relative to Balancer. So we go short Balancer, or we borrow the Balancer token, right? We profit when Balancer goes down, and we go long the thing that we believe will outperform. And then we get a chart like this. It's a strategy that works for many altcoins. Just have a look at the overall altcoin unlocks over time. So how much new supply hits the market and how much capital needs to flow into the market just to keep prices stable. This here is weekly unlocks, and it tends to be in the hundreds of millions of dollars every week. Especially this week is extremely aggressive with unlocks. And so this is the return we get, but that happens because this is the actual performance of the altcoin. And this is a chart we see very, very often. Just have a look at your favorite altcoin with high unlocks relative to Bitcoin, relative to Ethereum, and you're likely going to see a chart that goes down quite consistently. Who's getting all the tokens? Who's benefiting from this? It's the founders, it's the contributors, it's the early investors. They are all dumping on retail. So when you're wondering why your altcoin portfolio tends to underperform Bitcoin all the time, it's because of that, right? It's because all those people dump on you regularly. And so that's how we make money as well. We make money when the insiders dump on retail, and most retail investors don't know how to play the game. I made a lot of tutorial videos on the topic, how to bet on relative valuations with perpetual futures, how to do proper risk management with those bets. And then also, and this is the big thing, right? How to provide capital to a capital pool so that every trade that I make automatically gets copied with your funds as well. So that something like this isn't theory, but actually becomes practice for yourself as well. You don't have to necessarily go through all of those tutorial videos and have to do active trading all the time if you don't have the time. If you do want to trade yourself, there is obviously the offer, because I do share my trades in real time as well, right? For example, here, this is the Balancer short that I announced on the 19th of July of last year. So that was over here. Since then, Balancer outperformed Ethereum by more than 116%. And so if you've got some capital, but also some time, then there's the monthly membership, right? You just sign up, you watch a few tutorial videos, and then you can copy trade whatever I do. And of course, also do additional trades besides that. If you don't have much time though, if you cannot do the active trading yourself and you're busy with maybe managing a business or a very busy job, you've got the capital, you don't have the time, then you can also automatically copy trade me. The automatic copy trading feature is available for the annual subscribers. So if you sign up for the annual premium membership, you get a bit of savings as well, but you also get access to the automatic copy trading, which again, I've just recently started. We don't know yet how this will perform, but in the last 2.5 months on my private account, it did pretty well. And very long term with borrowing and lending platforms, it also did pretty well. I can't guarantee that it will continue to work in the future, right? Prior returns are no indication of future returns, as people say. But in general, I try to get the odds in our favor, right? When everybody dumps on retail, we can still profit from that if we set ourselves up accordingly. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.